Away from that, now we're looking at a very important topic today. First, we'll look briefly at the top Nigerian quoted companies listed on the NGS with the largest number of employees as of 2024. Many of them are big corporations. There, all of them quoted on the NGS, talking about Nigerian Stock Exchange. And of course, away from that as well, we'll also look at the Nigerian commercial banks that has recorded 3.77 trillion naira in terms of loan losses since 2023. That is indeed a very huge one there for the banking sector to chew. These are some of the two topics that we'll be looking at today. And my guest, Dr. Adegboyega Adebajo, is an investment banker and, of course, an economist. Is also the lead advisor, Amitez and Ashla Advisory Limited. He is going to join me from Lagos for us to discuss this very important topic. We'll go into the conversation after this very short break. Don't go away. Glad to have you back. We're hoping to get Mr. Adegboyega Adebajo, an investment banker, an economist, and also the lead advisor, Amitez and Ashla Advisory Limited, to join us on the show. But before that, let's look at some of the top companies with the largest employee quoted on the Nigerian Stock Exchange. We have that graphics there, of course. It's there right there on your screen. Dangote Cement is leading the chart there, 20,910 people that it has in its employee. I mean, that is a direct employment where you are talking about the other chains of employment. It actually could be more than that. Followed closely is First Holdco, talking about the First Bank of Nigeria PLC. There is also there a distant second, you will say 9,950. That is also a huge number. Julius Berger Nigeria PLC, 9,419. That is also another huge number there for Julius Berger Nigerian PLC. United Bank for Africa UBA, 9,223. Of course, don't forget, these are high capped equities. We call them quoted on the Nigerian Stock Exchange. And of course, these are the number of people in their employment. Access Holdings Nigerian PLC is also up there, 8,939. Zenith Bank, 7,704 is a huge number. So, of course, Jitco, talking about Guaranteed Trust Holding Company, is there at 5,803. Of course, Flami Nigerian PLC at 5,404. And of course, FCMB Group, talking about the First City Monument Bank, 3,796. And of course, the last but not the least, there is Stanbic IBTC, 3,243. It's indeed a very huge number for some of these companies who have employed quite a whole lot of Nigerians and, of course, other nationals in their companies there. Let me get the take of my guest, Dr. Adegboyega Adebajo, an economist, investment banker, lead advisor, Amitez and Ashla Advisory. He joins me virtually from Lagos. Good morning, Mr. Adebajo.
Good morning, Yusuf. How's everything?
Very well. Good to hear from you again after a while. You see,
yes.
Look at those companies there. I mean, a lot of numbers there. Look at the Dangote Cement, over 20,000. First Holdco there, almost 10,000 number of people in their employment. Talk to us about the impact of these companies on the Nigerian economy, largely.
Well, you no doubt about it. When you look at those names on the list, you know that they're practically the top performing companies or the other. And I guess, given the way we tend to shout about the unemployment rates in Nigeria, it's a good thing that these companies are actually doing this much to essentially employ people. You can imagine, okay, if, for instance, those companies were at half the rates in terms of what the persons they're employing right now, we wouldn't have a situation where we could even be talking about it this way. Because the big question will then be, who employs? Typically, the government has always been the largest employer. And that's a major thing from certain perspectives. But what's key here is that these companies are producing, they are essentially beneficial to the economy, and they have ensured that as their business has grown, they have risen in terms of employment. One thing that tends to be very interesting is to be able to look at gender distribution amongst these companies. Presently, once there's still, I mean, it's a toss-up as to whether it's a much more male-dominated industry or it's a female, with a glass ceiling type of industry. But no doubt, with the youth population and a lot of people under 35, the greater percentage under 35, the labor size available in the country is pretty large. And I think it's a good thing from the government's perspective, certainly, that there is some degree of employment. And the lesson here really, in terms of policies to the government, is to endeavor to encourage the large companies to grow. Because with this growth comes employment, and that puts less pressure on the government.
Indeed, with this growth come quite a whole lot of employment, and of course, like you said, puts a lot of pressure on the government. Let's look at, in terms of benefits to the government, how much of contribution do you think they will make? Of course, I know government will be making quite a whole lot in terms of tax and, of course, VAT collections from some of these companies. How much do you want other upcoming companies to learn from this already established one? Of course, these ones are more like when you say these companies, they have paid their dues. They have been there and they have, remain largely sustainable.
Yeah, so if we combine the salary expense of these top 10 companies, we're at about 1.69, let's just say 1.7 trillion naira in terms of salary expenses in 2024. And like you rightly said, you can imagine what this would have contributed to the government in terms of personal income tax, not to talk of the corporate tax those companies would also have paid. So for the upcoming companies, I think the important thing is to learn the structuring that has enabled these companies to grow. One also feels, and this is very important, again, I lean towards saying this to the government, that where possible, and if possible, a lot of incentives should be provided for as many more companies as possible to grow. Because if they do, you get the kind of results which we have presently. And that's exactly.
Hello, Mr. Adebajo, are you there?
Exactly, the company is greater employment. Some people would say that's, hello, can you hear me?
Go ahead, I can hear you loud and clear.
But people, these are blue collar jobs, all jobs as it were, because the Dangote cement is a lot of manufacturing, and he's got that pretty spread all over the place, not just in Nigeria, mind you. He has endeavors in a few other African countries. But it all adds up to occupation. It all adds up to the ability of these employees to pay tax, to have savings, and to be able to have a lifestyle that is quite useful to them and for the benefit of the government too.
Indeed, Mr. Adebajo, you are also an investment banker, and if you look at the list, the top 10 that we are having here, we're having about 7 banks on that list. One would have expected that we should have more manufacturing companies on that list there as well. But are you not concerned that we are having more banks than manufacturing companies?
Well, I rather than concern, first of all, let me say this tells you something about the structure of the Nigerian economy. Primarily, the service sector has grown and continues to dominate in so many ways. And if by chance we have a tech bubble, you're going to see the service sector grow in leaps and bounds. Sadly, I would say the manufacturing sector has diminished in size. You want to look at flour mills there. Flour mills is the oldest, well, beyond First Bank. Flour mills is the oldest company we have around. First Bank is certainly older. That's FBN Holdings, and that's if we're going to count First Bank. But it speaks to the fact that flour mills has a certain niche. They built a reputation over time, and they have a product that remains in demand. So if we're going to start thinking about changing the structure, service is good, but we need a lot more production. We need to see companies that are in the manufacturing sector starting to come up and actually take a place, you know, in lists such as this. So yes, it's not a concern. It gives a direction or an indication where policy direction should go.
All right. What will you say about those who say Nigerian banks are not doing the real banking? I mean, supporting the small businesses to grow and employing more people instead of the banking dominating the market. That is the area I'm so concerned about. There have been an argument that the banking in Nigeria are profit oriented instead of service oriented.
So that seems to always be the argument, but I guess later on today, when we look at the structure of bank credits and what's looming in their balance sheets, we'll be able to think about that in greater detail. Right. And realize that the banks themselves are doing whatever they can to survive. It's certainly not easy. From an asset and liability management perspective where banks are concerned. But one thing they've done is they've been able to leverage on technology significantly in terms of their processes, and they've been able to use those processes where technology brings efficiency to earn a lot of money. And that goes to their bottom line, as it were. So again, this is for other service companies to learn about, and this is for manufacturing companies to think in terms of how their businesses can be structured.
Indeed, that takes us to the next topic that we're looking at, talking about the top Nigerian listed banks with the highest loan losses in Q1 2025. You have actually talked about that briefly there. Let's go in there and see why we're seeing a lot of non-performing loans in the Nigerian banking industry. We look at how they are looking at there. If you look at the performance there in terms of loan losses, you see that the likes of Wema Bank is there at 1.13 billion naira there in terms of its loans obligation. You have Stanbic IBTC is also down there as well, 4.10 billion naira there as well. Not so good there for Stanbic IBTC. Fidelity Bank is also right there, 10.83 billion. FCMB, talking about First City Monument Bank, 12.69 billion naira. Jitco, 13.4 billion. Zenith Bank, 36 billion naira. First Holdco, talking about First Bank, 41.20 billion naira. And of course, Access Bank, 70 billion naira. And of course, Eco Bank, which recorded the largest or the highest, you will say, 96.6 billion naira in terms of non-performing loans there as well. How much of impact do you think this will have on the banking sector? I mean, on their confidence rather to give more loans to the economy, Mr. Adebajo?
Well, from the news or emanated from the central bank a couple of weeks ago. You will recall that the central bank issued a circular and noted that banks that were enjoying forbearance from the central bank should not pay bonuses to their staff and should not declare dividends to be distributed amongst shareholders. The essential principle behind the prudential guidelines and loan loss provisioning is that, you know, loans that are doubtful or loans that have gone bad should always be written off against the profits. What the forbearance did and what CBN provided a few years back was to say, okay, don't take this all out against your profit at once, and spread it over a certain number of years so that the impact on your profitability will not be so significant as for you to report losses. And Yusuf, you rolled out a list of figures, which was essentially Q1 2025 losses. But it's interesting because in my research, I have looked at losses from 2023 to the end of Q1 2025. And when you do so, you're seeing Zenith at about 1 trillion over that period between 2023 and March 2025. You're seeing EcoBank Transnational at 869 billion, First Bank at 586 billion, UBA at 423, GTCO at 258, Access not coming sixth at 247. Now, I could run through the list, but it's not so much about their names. But when you think of those names, you think in terms of how active or how specialized they've been. EcoBank, for instance, is pretty much a specialized bank in terms of what it does. And what we're seeing is the impact, not necessarily of saying that the banks have made a poor judgment in terms of the loans they have given. These loan losses have occurred, and for certain reasons. We've had the situation with the currency depreciation of the Naira since mid-2023, and that led to a lot of foreign exchange volatility. About 40 to 50% of bank loans are exposed to sectors that are highly sensitive to exchange rate fluctuations. And given that, it was inevitable that this would impact the profitability of those loans. We also had the high inflation. If you recall, it was as high as 34% in 2024, and it's averaged just about 25% this year so far. Now, what this has done is that with the rising cost of living and the cost of doing business, the risk of default has increased. And for a lot of businesses, they're going to have to renegotiate some of these loans. As a matter of fact, we've been discussing here the impact of the CBN increasing the benchmark interest rates in its bid to fight inflation, of course, and that makes sense, okay, to raise the benchmark interest rates. But what that has done is it has also increased borrowing costs. Essentially, the CBN also wanted to discourage borrowing, okay, so as not to push more inflation and to reduce the cash available for that. But as the benchmark rates increased, so did the interest rates on existing loans. And so what we've had is people who have borrowed at certain lower rates are suddenly faced with having to repay at a higher rate. And with inflation itself shrinking margins and demand dropping in certain sectors, sales would certainly not have been at the level to repay loans at such high interest rates. So we ended up with sluggish credit repayments, and the banks are certainly not to blame for this, you know. So but there's a lot more to this, perhaps.
There's a lot more to it, perhaps. What do you think that a lot more could be? Are you saying that the CBN policies is not favoring the commercial banks?
Well, it's not about favoring them at all. The CBN has a role to play. Monetary policy from a macroeconomic perspective, expecting it to trickle down to the microeconomy. And everything the CBN has done, when you look back at it since 2023, you will find out that for what it's worth, inflation has been curbed to some degree. We are tending towards stability in terms of the exchange rates. The gap between the black market, and the official rates, which caused some arbitraging and put a lot of pressure on the naira, has significantly reduced. So it's a lot more possible to predict where exchange rates are. So we're tending towards stability. And that simply means the CBN's policies have been as they were. But with banks, it's not so much as being against them. Remember that prior to 2023, the banks were coming from an era where liquidity was pretty much available. Loans, the rates of interest were such that loans were being given to businesses. The prospects seemed good. The dollar exchange rates, was still at 400 then, even though there was that gap and there was so much room for arbitration and, I should say, indiscretions in the foreign exchange market. And so what the CBN has just done is to bring some sanity into it. Let's not see the profits being reported as essentially favoring the banks or the policies as not favoring the banks. Because one, you've got to bear in mind that those banks are mostly in a state of forbearance from the CBN at this rate, and that's essentially because you may not want to essentially blame them for giving bad loans. Okay, good loans can actually turn bad when the economy or the indices in the economy do rather go against the business. Okay, so good loans can go bad, and ultimately the banks carry that. The thing is, even where you have restructuring of loans, extension of loan tenors, the reporting requirement is there, and CBN is doing an excellent job in terms of regulatory oversight. But let's hope that as we go ahead, the CBN's regulatory policy and its lending policy starts to shift in such a way that credit becomes available. But a major concern will be what to do with these loan losses. Those figures are significant. You can't always get back all the bad loans, but there is something that must be done, that can be done perhaps in terms of restructuring them. So the loan to deposits ratio, which previously encouraged lending, has been shifted. And right now, the banks are tighter in terms of how much they can give out as loans. So that's one thing that created impairments. Maybe the CBN would consider being softer in terms of the loan to deposit ratio. Another thing is that banks may start to look at sectoral vulnerability. The oil and gas sector has been a major sector that has impacted banks negatively in terms of what has happened to exchange rates, and how that has affected their bottom line and how those risks have crystallized. So that's one sector. And then general commerce, of course. And if we're looking at oil and gas and general commerce as being the major recipients of bank credit, and therefore most likely the sectors that have contributed to these loan losses, it simply means that as a bank, it's time to start looking at what other sectors are there that will bring about growth and to which credits can be moved. First of all, I would talk about agriculture. I will talk about tech. And, when I say agriculture, I'm not just thinking in terms of primary produce, but also in terms of processing and agri-business related projects. So there's a need to look at sectors again in the economy to drive for growth, because oil and gas would always be there. There are no subsidies anywhere, so the margins are not the way they used to be, and therefore it can't be as attractive anymore. It's just a stable, predictable margin sector. General commerce, it tends to go up and down with the exchange rates. The devaluation of the naira, when it happened, shrunk the capacity of most commercial trading companies to be able to access volume which they used to do. And if they did anyway, they've certainly transfer those prices onto consumers. And with consumers not having the disposable income to buy that, then the volumes start to drop. So these are things which must be looked at as we go ahead.
A lot to look at there. Mr. Adebajo, as we begin to wrap up the conversation, a lot of people have also, or some financial analysts have also pointed to the economic instability, currency devaluation, and high interest rates as part of the reason why we're having non-performing loans. How much of this do you think is impacting on the banking sector?
Well, every single one of them. Right now, we can see and tell that banks are not recording as new credits or new credit approvals as they were prior to 2023, when the loan to deposit ratio was softer or easier. And so if there are no new credits being given, it means that most of these losses we're seeing now are essentially loans that were given much earlier. Let's just step back a bit, Yusuf. The prudential guidelines asks you to start providing after 6 months. It's not immediately the first time there's a default that a loan is considered to have gone bad. And banks would always do their best. We always say borrowers should have a good relationship with banks, where they can restructure their loans and discuss such terms and conditions as may make it possible for them to pay back. Because that's key to banks. The first thing they want is not the collateral, it's the capacity to repay. That's more important than whatever collateral may be provided. And so after 6 months, going on to 9 months, if it's difficult for the company to do anything about it, that's when the loan starts going into classifications that they can now be referred to as loan losses. So yes, loans, if they start to go bad or when red flags are typically categorized based on how long they've been there without being serviced. And there's a limit to which, you can keep them there without being serviced and not call them bad or not call them a loan loss. If the loans are ever repaid, it goes straight to the profits of the bank. But what this tells us for Q1 2025 is that for each and every one of those banks, it is likely that whatever profit is achieved in 2025 will be reduced by the volume of those loans. So it's not good news to the banks. It's not something they want. And they're probably going to try to do as much as they can to scale up their revenue so that they can absorb these loan losses and report the kind of profits that one would expect.
Indeed. Of course, in the midst of all of this, we're seeing the bank deposit with CBN rising to 907% to about 68.9 trillion naira. I mean, that is a very huge number there. Does this show that our banks are indeed healthy in terms of stability?
Well, it's a toss-up, because I also have news that at the start of Q1, banks actually started in, you might dare say, almost a negative-like position, and it was necessary for the CBN to start. There was 255 billion negative opening balance in Q1 2025. So there is some kind of pressure in terms of liquidity across the sector. It's tight, definitely tight. And this is a result of CBN's own policies, as you say. The cash reserve requirements are high. So a lot of the funding you see in the bank is regulatory, it's regulatory compliance. CBN wants to control inflation, and they would, of course, ask those banks, if this is a cash reserve, then that amount of money from your deposits, so that percentage must be put in there. So that's what we've seen. That reflects the liquidity And if credit repayments are sluggish from the private sector, you know, or from whatever sector, it will also mean that the banks aren't getting back as much cash as would otherwise have happened. So with the policies aimed at curbing inflation, restricting availability of cash in the system, deposits that banks have in the central bank don't necessarily translate into liquidity in an instance. However, they reflect a certain degree of stability or strength on the balance sheets of the bank themselves. And that's why they're referred to as cash reserves.
Indeed. Finally, now, a lot has been said now. What do you think banks should do now in this regard with everything that you have said now to ensure that this number of non-performing loans, NPL rather, did reduce drastically?
Well, it's very, very for every bank. And recall that whilst we've got banks that have national licenses, we also have those that are regional. But from a certain perspective, there's a need for banks to strengthen their risk management, okay, such that whatever new loans may need to be given, and there are lots of businesses that are accessing new credits. There are performing businesses out there who have been able to pass on the cost of doing business to consumers because of the essential nature of what they propose. So risk management should be strengthened. In addition, I think banks should also look in terms of recovery, where certain loans may have gone bad because of the economy. Is there some way in terms of which companies within that sector, or from a sectoral perspective, something that can be done? You will recall way back when the financial crisis happened in the US, and it spread over from the derivatives time during Obama's time. And the US government came up with quantitative easing, which bottom line was essentially like intervention or making cash available, or credits available rather, to certain sectors so as to refloat activity in those sectors. I want to believe that at some point in time, we're going to get there. So in the meantime, risk management and recovery needs to be strengthened. Something else banks must do is to continue with their efforts in terms of digital transformation. Wherever technology can make a difference, they should do so.
Right.
And again, this tends towards increasing revenue. And of course, to the extent that the regulators allow, they can always explore alternative revenue streams. And let's not forget that banks are currently in a capitalization race.
All right.
Or should I say recapitalization race?
Mr. Adebajo, I'm afraid we have to go now. Our time is already well spent. We are totally out of time. I must thank you, Adegboyega Adebajo, Economist, investment lead advisor, Amitez and Ashla Advisory Limited. I must thank you for your time on Business Daily. We appreciate your contributions.
It's my pleasure.
Thank you so much. That is a wrap on the show today. We'll be back again tomorrow. I am Yusuf Akogu.